What we've seen in the financial markets is equity markets collapsing. We've seen 25-30% fall in equity markets. We've seen inflation beginning to rise again, a big negative in terms of the UK economy. And of course, we've also seen bond yields moving to unprecedented high levels. What that all means in practice for pension schemes is quite complex, but it's definitely not good news. Over the last 5 years, many companies in the Northwest have invested very, very heavily in their defined benefit pension schemes. They've diverted significant cash resources from investment in their business and actually from shareholders to plug pension scheme deficits. In many cases, this has been very substantial sums of money and is part of a longer-term funding plan. The negative impact on pension schemes is that a lot of that investment will have been lost with the 25% fall in equity markets. And if one looks at a typical pension scheme in the Northwest, which probably is still invested 60% in equities, that probably means the market value of the assets has fallen by 15%. I think we're going to see, certainly by the year end, so December 2008, a pretty interesting situation where the cash funding position of pension schemes, so the measure used by trustees, will show bigger deficits than before. But actually on the company balance sheets, actually the deficit position won't have increased so significantly. And we might have a rather anomaly here of companies with a surplus on their balance sheet as a company and a deficit in terms of the trustees. And that will lead to some very, very interesting debates between employers who underwrite these pension schemes and their trustees. As we move into recession, and some would argue we're already there now, but as we move into recession over the next 3, 6, 9 and 12 months, trustees of pension schemes, defined benefit schemes, will be approaching companies, finance directors, CEOs of companies in the Northwest seeking greater funding for their pension schemes because of the deficits that have appeared. This is going to come at just the wrong time for Northwest business. At a time when banking restrictions are becoming tighter, when cash is likely to be tighter in businesses, and unfortunately when many businesses are looking at redundancies and headcount reductions, and cash will be difficult. To have trustees asking for more cash is going to be a very significant challenge for many businesses. Companies, I think, now will begin to look a lot more closely at how they manage this risk. I would call this the pensions risk. How would a company with a large defined benefit scheme manage their pensions risk? And how can they find ways in which they can better manage that risk rather than investing more and more cash in that business? And I think what will happen is that companies will look a lot more closely at the investment strategy of those pension schemes, which hitherto has been managed almost solely by trustees, and will look very, very closely at the profile of the liabilities and how to manage those liabilities. KPMG is already actively advising many Northwest employers on how to manage their pensions risk. Increasingly what we were going to be doing is sitting down with Northwest companies and the boards of Northwest companies and really helping them develop a business strategy for pensions. When we talk to Northwest companies and finance directors and CEOs, the message back is that if they have a defined benefit pension scheme, that is going to be one of their top 3 issues for the next 12 to 18 months. And what we will see with our clients, in working closely with our clients, is developing a business agenda, if you like, a roadmap for pensions, so that companies can progressively tackle this issue. It may take 1, 2, 3 years to finally resolve many of the issues, but companies will be looking pretty progressively at that. And that's what we will be doing to help Northwest business tackle these sort of issues.